So Jessica, why should investors care about the impact of their investments?
There are a number of reasons. First, we believe at Veris Wealth Partners that all investments have an impact. It's whether it's a negative or positive, whether it aligns with your expectations or future performance. So this morning in our presentation, we heard a lot about financial wellness and advisors looking to promote their clients' financial wellness. And I think part and parcel of that financial wellness is a long-term view of investing. And so if you're thinking about the long term, you really need to be thinking about how businesses operate in the world and how they'll be successful in meeting the risks and opportunities that are presented to them over the long term.
You know, one of the things we often say in our organization is that financial markets are probably the most powerful institution ever created by human civilization. And so connecting investors with their wealth and connecting their wealth to these broader social and environmental issues that we're struggling with as a society, I think that they harvest that psychic income makes them feel better about, frankly, being one of the more privileged members on planet Earth, having built wealth and now benefiting from that wealth.
And I think, Don, that leads into our next question, is really there's some debate in the industry about whether you can have impact in publicly listed securities or if that's more just in direct investing or private funds. Do you want to speak to impact in public markets?
There is an interesting tug of war between what I'll call the fiduciary responsibility that management teams have to shareholders, but then what I would argue is also this fiduciary responsibility to society at large and the future. And so I think that we can harvest impact in public markets, and arguably you can probably harvest more impact there than you could in private markets.
I agree.
Because of the pressure that organizations or that investors can bring to bear on organizations. You know, think of BlackRock and the firearms debate that we're having in the United States right now. That's a very powerful impact, and so BlackRock is just merely responding to the demands of investors. And here we are. That's the power of capitalism, if you will. So how about you? I mean, what's your view on
fostering those operational efficiencies and fair treatment of employees and supply chains and responsible behavior around the world? Fostering that through shareholder engagement can not only enhance their financial performance over the long term, but is also having significant societal and environmental impact.
Absolutely. So I guess that would bring me to our next question, which is, how would one go about finding, good impact products across, an entire asset allocation and different, investment styles? Think of multi-factor or smart beta. How would we go about identifying great products in the impact space?
Well, it's certainly an evolving field, and there are a lot of products out there, and there are new products coming on all the time. For more mature products with some track records, some AUM under them, Envestnet and Veris have worked to develop the Select list, where we do a deeper dive. Envestnet really vets the investment process, and we look at the impact, and we do a deeper dive on those managers. And then, it's an early evolving field, so how different managers express their impact in ESG is in a wide range of stages of evolution, and whether they're still hearkening back to early days of socially responsible and using negative screens, they're using ESG integration, they're doing both, or they're expressing some thematic view, trying to capture future growth.
Oh, that's great, and I would add to that, at Mercer Advisors, we're a wealth management firm, so we're working with the end client, wealthy families that are, certainly have their views on impact and the impact that they want to see their wealth have on the market. I would say there's two dimensions that our investment committee generally looks at with respect to determining, whether or not something constitutes a good impact product. And the first dimension is we're looking for customization. So you referenced the different screens that are available on the Envestnet platform with respect to their quantitative portfolios. We found that very attractive because one of the things that is probably obvious to all of us these days is that we all don't agree on what is a positive impact and what is a negative impact. And
That is very true. That is very true. I agree absolutely that it's up to the asset owner, whether that's a person or an institution, to really express whatever and try and achieve whatever goals they're pursuing.
The second dimension that we look for in terms of what constitutes a good impact product is how are they quantifying, how are they measuring their impact, right? Are they measuring carbon emissions? Are they measuring, human well-being, wellness? So that's what we're looking for are more quantitative measures of impact.
So do you want to talk to how ESG factors can influence return?
One of the things I'm always trying to understand is where does ESG fit within sort of this established academic framework around returns? And I think it could fit in a couple of different places. So companies that have really great ESG practices, at least in the short run, should have higher expenses, you would think, right? Because if it were less expensive to have great ESG practices, businesses would already be doing it, right? Look at Apple, look at Google, look at Amazon, right? These are classic tech companies, everybody loves them. Google has very strong ESG views and they've communicated those to the marketplace. And so I think investors are drawn to that, so that could bid up share prices. There's also some academic work that suggests that companies that are more socially conscious, that investors have more trust in their management teams. And they, by definition, then they give management teams more room to run the organization rather than focus on very short-term, every 90-day earnings calls. And there's a couple of faculty at Stanford that have been working on that, so it's pretty interesting research to see. So I think ESG can have a very positive impact on returns.
I would agree with that. I think as we talked before with employee retention and investing in employees and fair practices can certainly reduce costs, I think, particularly in this employment market.
Companies that have great ESG practices can attract longer-term capital. Well, by definition, if I have a longer-term financier of my assets on my balance sheet, that makes my life a lot easier as a member of the executive team, right? So, but there's also the revenue side. I'll share a story. In my town, we have a dry cleaners that claims to be environmentally friendly, all natural. I know nothing about the dry cleaning business, but I take my clothes there religiously because they claim to be environmentally friendly. And I pay a premium for that relative to the dry cleaners that's actually closer to my house. Right. So I drive further, I pay more, and there is a market segment that's willing to do that.
Well, and that's a perfect example of how your individual values are also part of a larger societal trend that are ultimately driving revenue? So if you invest in that equation, is that driving revenue and better performance, or is that making you feel better about your investment if you were to invest in your
It's definitely helping the revenue of the dry cleaners. I don't know if he attracted longer term capital, but it's definitely helping his revenue side.
Right. No, that's a good example. That's a good example.
So maybe to transition to our maybe our next question here is, why are women and millennials specifically drawn to impact investing, ESG? And are there any specific products that focus on one group or the other?
I think that there's certainly a lot of press around that recently, and there's a lot of data to suggest that the millennials as a generation care a lot about social issues and have a mistrust of institutions, and they sort of have a whole framework that makes impact investing appeal to them and wanting to solve those problems with their capital. And there are new products, let's say gender lens products, or investment advisors that are investment managers that are looking more at the culture of companies, so fair labor practices and equality and fraternity leave and fair pay and those issues. So are those women's issues? Are those societal issues? Are those business issues? I would submit they're all of those issues. And if you're not treating half your workforce fairly, that's not going to be a good outcome for a company in a tight employment market. So there are interesting products that are trying to, and the data is trying to evolve to collect the data around, not just counting women on a board of directors and women in senior management, but even down into really trying to capture how companies treating their employees as employment practices.
So there's frustration, right, around impact investing in that everyone says that impact investing is going to take off, it's the next greatest thing, and one of the things we're finding is that people are very interested in it, but we're just not seeing the AUM flows that I think initially we would have expected. So why do you think it's getting so much attention, and maybe where's the missing link?
The lack of uptake, or relative lack, it could just be that it's still early in the evolution and the understanding. It is a complicated topic, I think, as we've discussed. So I think there's some hesitation around that, just understanding what it all means. And there is a stigma about this, its inverse relationship to returns, possibly, which makes no sense. But I would say it's a false paradigm, this return impact paradigm, but it seems to be perpetuating among people who don't really have an understanding of the issues.
I have a suspicion that the lack of uptick in impact investing is because folks are probably shy away from having deeply personal discussions with advisors around their values. And so one of the things I think we need to do is empower and train advisors to really tackle the spicy issues. Don't be afraid to ask the client how they feel about climate change or abortion or some of these more politically charged issues, and then ask our clients, well, how would you like to incorporate your values into your portfolio? So I think part of that is just having a great conversation with clients and having a safe space where it's okay to disagree on some of these big issues, but let's make sure your portfolio really reflects your values.
Right, and in that the disagreement is not what's important. What's important is fleshing out what the asset owner is trying to achieve, and then match that with a portfolio that hopes to express that.
Absolutely.